Are you investing like a 65-year-old while you are currently in your prime growth years? In this Invest With Me video, we'll talk about the investing strategy for each decade that you add to your level, also known as your age. If you're new here, my name is Ron and welcome to Pinoy Stock Investor. But before we start, let me know down in the comments how much more years do you still have before you enter your retirement. It'll be really curious to know. And before we start, these are not investment advice, and I am nowhere near being an investment financial professional. So make sure to do your own research and to consult your own financial advisor before making any financial decisions. Okay, let's start with the market check. Right now, we'll look at the S&P 500. So the S&P 500 is currently up by 10%, 0.10%. And Dow Jones is currently up by 0.25%. And the QQQ or the NASDAQ is currently up by 0.24%. So we have a really green market. But looking at the portfolio today, we are currently down by 0.01%, $20 down today on the full portfolio. And looking at the taxable account, we are currently down by 0.06%, which is down by $70. Okay, all right. So today we are going to invest $109. I don't know where the $9 came from. It just, when I added the $109, 100 in there, I just pressed 9 instead of 0, so it's $109. Okay, so we're going to invest $109 to the portfolio today. And it looks like we have a mixed portfolio today. Today, Apple, Amazon, Google, and Meta is currently up, and Berkshire Hathaway, MasterCard, Microsoft, Uber is currently in the red. Let's plug in our investing budget to the investing Google sheet or budget sheet we have right now. Okay, so for industrials, we are going to invest $10.9. For financials, we are going to invest $11.44 per company. For communication services, we are going to invest $16.35 per company. And for technology, we're going to invest $14.17. All right, let's start with investing in Uber. So for Uber, we are currently down by 9.01% as a total loss for Uber. That is $715. And that's in that $715, we are currently down today by $130. Okay, we're going to invest $10 to Uber. And that is 0.137 shares of Uber. Okay. Next, we are going to invest in MasterCard. Looking at our investing sheet, we are going to invest $10 also in MasterCard. Okay, $10. And that is 0.019 shares of MasterCard. Okay, the next one is Google. Currently, Google is up by 81.55%. That's a total gains from Google. That is about $9,703. And we are currently up today by $96 or 0.44%. So Google is definitely carrying our portfolio. 81%. It's really good. Okay, we are going to invest $10 to Google. Okay, and that $10 is 0.0 32 shares of Google. Okay, so right now, you're probably on your, I mean, if you're in your 20s right now, you're probably in your beginning phase or early accumulation phase, which usually focus on building your financial foundation. This is where you establish a good credit, building your emergency savings for at least 3 to 6 months, and starting contributing to your retirement accounts. For people who are in the States, that is usually the 401k and the other IRAs. So this is where you start those kinds of financial planning, your foundation, before you even start investing. And once you finish all those foundational things that you have to do before investing, your investment strategy for this phase of your investing journey would be a high growth kind of strategy, which is really aggressive kind of investing. And this is because you are starting early in your life. You have how many more years before you reach your retirement? So the volatility that your portfolio is possibly going to face, you will be able to overcome those volatility just by holding on to the stocks that you believed in. Okay, this is a kind of high growth strategy for you, and between high risk and low risk kind of preference for you, because there are two things that highly affect your investing. One is your age, and two is your risk profile. So if your risk profile, if you have a higher risk tolerance when it comes to investing, and you know that you can weather like a high volatility kind of situation, and you can remove yourself emotionally from those kinds of events, you can consider yourself as a high risk tolerance. And one of the best asset that you could hold is a really aggressive kind of asset. In this one, we have an example. This is VGT, which is the Vanguard Information Technology ETF. This ETF focuses on high growth tech companies like Microsoft, Apple, and Nvidia, and it's aggressive and volatile at the same time, but has historically outperformed the broader market. Now, if you're in the other side of the equation, wherein you have a low risk tolerance, but you are still on your early 20s, you might want to reduce the amount of volatility that you have in your portfolio. So in this case, a good total stock market ETF would be really great for you, which is for Vanguard, it is Vanguard Total Stock Market ETF, or VTI, which instead of betting into one sector like in the high risk tolerance kind of equation, over there you have VGT. Over here you have VTI, which is the whole US stock market, and it provides growth while significantly reducing the risk of single industry failing. So you have more exposure to different sectors. This is the total stock market ETF of the entire US. So you have more buffer when it comes to volatility. Okay, so the next level would be your 30s. And in your 30s, this is the development and accumulation phase, or the building phase. This is where your career starts to advance, which results to increased income for you and allowing you to increase your savings. The goal for this level is to reduce the anchors that's pulling you down or that's slowing you down. So if you have debt, you start paying off all those debts. Now, majority of the people in their 30s starts to save up for a house, or sometimes they are roughly saving a one whole year of their income as a retirement budget. So in this level, your investment strategy is still a high growth potential because you still have more amount of years that you going to cover so that you can overcome that volatility still. If volatility is happening in 1 year, you can try to overcome it by keeping invested or dollar cost average to your investments, so your growth potential still continues to grow. Now, in this level, some of the assets that you might be holding would be growth kind of assets, depending on your risk tolerance. So if you have a high risk tolerance, you're probably going to invest in Vanguard Growth ETF or VUG. This is an ETF that targets large cap companies that are expected to grow at above average rates. It also offers a balance between pure aggression of tech and the stability of large corporations. It holds large cap companies like Nvidia. And if you're on the other side of the equation, which is the low risk tolerance group, earlier you were trying to invest when you were in your 20s, you're trying to invest in VTI, which is the total stock market. Now, in this level, you're more concentrated just to the S&P 500. So you're probably going to invest in VOO, which is the Vanguard S&P 500 ETF, which tracks the 500 largest US companies. Okay, let's move on to our investment. Next, we are going to invest in Meta. That's the other communication company on our portfolio. And right now, we are currently up in Meta. The total gains in Meta is $175. That's 2.83% up. And for today, we are currently up by $80. Okay. We are going to invest $20 to Meta. And $20. That is 0.03 shares of Meta. And I'm also building my position in Meta. This is one of the newest companies that I've been holding, and I'm trying to increase my position in this one. Okay, next company, we are going to invest in Apple. All right, so right now, we are up by 64.18% in Apple. That is $9,000. And for today, we are currently up by 0.58%, which is $138. Okay, we are going to invest $10 to Apple. You know what? I changed my mind. Let's put $10.50. And that is 0.04 shares of Apple. Next, we are going to invest in Berkshire Hathaway. Currently, we are up by $6,000 in Berkshire Hathaway. That is 38.53%. And for today, we are currently down by $69. And that is 0.32%. Okay. And we are going to invest $12.20 to Berkshire Hathaway. And that is 0.024 shares of Berkshire Hathaway. Okay. So after your building phase, after the building phase comes your level 40 and level 50. And in level 40 and level 50, you are balancing your investment. So at this stage, you peak your earnings, and right now you have the same, or this is also where you peak your expenses, because at this level, highly likely you have kids, and raising kids is really expensive. And if not, you're probably sending somebody in college, and college is also expensive. And at this level, this is where your highest expenses are. And this is where you revisit the goals, the financial goals that you set before when you were on your 20s and your 30s. Right now, you should be able to max out your retirement every year. You max out all your contributions every year and balance the growth of your portfolio with portfolio security. So the reason why this is the balancing phase is this is where you're closing in to your retirement age, and you don't have enough time to weather that volatility as much as you have when you were 30s. So you're slowly transitioning in to making your portfolio a balanced portfolio. So at this level, you are trying to minimize the downside for on your portfolio. Okay, so assets like VIG, or Vanguard Dividend Appreciation ETF. This ETF focuses on companies with a record of increasing their dividends every year. So they're consistently increasing their dividends. And also these companies are usually very healthy and provide a growth light kind of experience with a less downside. So companies over here are like ExxonMobil, Johnson & Johnson, and Walmart. So these are the kinds of companies that you're going to see in this ETF. Okay. But they also have companies like Microsoft, which is the next company that we're going to invest in. Okay, let's go invest in Microsoft. So right now in Microsoft, we have $3,800 as a total gains. And currently today we are down by $252. So Microsoft has been really having a hard time the past weeks right now with all these news and with all the short-term news that they are facing. So we're going to invest. We're going to capitalize on that, and I'm going to invest more in Microsoft every time. Right now, going to invest $15 to Microsoft. Actually, let's change that, and we'll change it to $17.25. So that is 0.042 shares of Microsoft. Okay, next we are going to invest in Amazon. Okay, right now our Amazon is up by 10.05%. That's a total gains of $1,300. And for today, we are currently up by $51, which is 0.34%. Okay, today we are going to invest the rest of our investing budget, which is $20.56. And that is 0.095 shares of Amazon. After your 40s and your 50s, you're now entering your 60s, which is the preservation or pre-retirement phase for your investment journey. So this is preparation for leaving the workforce, because in 5 years, in 5 or 6 more years, you're going to be retiring in this level. So you're trying to prepare for your income to drastically go down because you're going to leave the workforce. So this is a preservation kind of phase for you. So the goal for this level is to assess your retirement income and see if you need to increase your income and to protect whatever accumulated wealth you have invested in this level. So you wanna reduce the volatility or reduce the risk in this level. You probably shift to heavily income generating assets, like dividend stocks that are high yield to protect your income against market downturns. So that's in this level. That's the kind of strategy that you're doing, and the kind of assets that you're gonna hold in this level, since you're preserving your wealth, is the Vanguard High Yield Dividend ETF, or VYM. So this is the kind of stocks that targets higher than average companies or higher than average dividend paying companies. And it provides an immediate cash for or immediate cash flow, which can be reinvested back to the portfolio if you don't need it. And of course, after 5 years, you're going to be in your retirement age. And this is the distribution pace of your investment journey. So the goal here is to generate income from accumulated savings to live on, because you don't have work anymore, you're retired. You don't have any source of income, or you don't have any major source of income, because your major source of income was your work before. Now you remove that. In your situation, you probably have a bit of social security and everything in there, but at the same time, you still want to increase the income that's coming in, and your investments will be the ones that would do this for you. So the goal is to generate income from accumulated savings to live on. And this investment strategy that you're going to do over here is to prioritize income and preservation, holding roughly 18 to 36 months of expenses in your cash or cash equivalents. So your emergency funds over here is already funded. You have saved it up, and the income from your investments will be the ones that gonna sustain you on your daily living expenses. Usually in this level, the assets that you are holding will be a more aggressive dividend paying asset, like Vanguard Real Estate or VNQ. This invests in REITs that pays high dividends from property income. It offers high yield potential, but comes with a more specific risk. And that risk is VNQ is focused in the real estate market. So if any bad news, any short-term news in the real estate market, VNQ is heavily affected. But you're not focused on that. You're focused on the income that investment gives you. There was this study where researchers put people inside a brain scanner and asked them to think about themselves tomorrow, and for 1 year, then 5 years, and then 10 years. And then they asked these people to think of a celebrity, someone that they know. Like in this scenario, they asked them to think about Matt Damon and Natalie Portman. And what's very surprising here, and what they found, is that we think of ourselves in 10 years' time just like how we think of strangers. So bear with me. Let's do a quick exercise. How long before you reach your 65? Do you think you will have the same hobby? Do you think the same favorite food will make you happy? And do you think the same taste in music will give you that groove kind of situation? So the foundation that you are currently building will help the future you. And pretty soon, the future you will be the current you. These strategies are not set in stone, and you can always pick the one that works for you. And what's important is that you start investing to build your future. If you get value in this video, don't forget to subscribe and like this video. It's free and it will definitely help my channel. I hope you able to see how important it is to invest early so that you can help your future self. Have a great day and peace. Oh, and by the way, if you want to read about that study, I put the link down below in the pinned comment, so it'll be easier for you to see what I was talking about in there. Okay, bye.